Imagine you just came into $50,000. An inheritance, a bonus, the sale of a house. You know you should invest it. But a voice, maybe a friend, maybe your own caution says, don't put it all in at once. That's reckless. Feed it in slowly to be safe. It feels obviously right, and most of the time, it's the more expensive choice. Let's look at the actual math. There are two ways to put that money to work. The first is lump sum. You invest the whole amount today, all at once. The second is dollar cost averaging, where you split it into equal pieces and invest them on a schedule, say a 12th each month for a year, with the rest sitting in cash until its turn. One important note, this is about a lump you already have. Investing a slice of every paycheck as you earn it isn't averaging in. That's just investing, and it's always right. The question here is narrower. You have the money now. Deploy it all or drip it in. Here's the fact everything hinges on. Over history, the market goes up far more often than it goes down. In any given month, stocks have risen roughly 60% of the time. In any given year, closer to 3/4. The market's natural state is drift upward. So, every month, your money sits in cash, waiting its turn to be invested, is a month you've likely given up that upward drift. So what actually happens? Vanguard ran the comparison across decades of history and multiple countries. The result was consistent. Investing the lump sum all at once beat averaging in over the following 12 months about 68% of the time, roughly 2 out of 3. And on average, the lump sum investor ended up with a couple of percent more money because their cash spent more time compounding instead of waiting on the bench. 2% may not sound like much, but on a large sum, compounded for decades, it's real money. But, and this matters, 2/3 is not always. About 1/3 of the time, averaging in wins, and it wins in exactly the moment that hurts most. When you invest your whole lump right before a sharp drop, put it all in the week before a crash, and you watch the full amount fall together. Averaging in, by feeding money in slowly, would have bought some of those cheaper prices and softened the blow. So it isn't really a strategy for higher returns. It's insurance against bad timing and against your own reaction to it. Because here's what the averages leave out. If you lump everything in and the market drops 20% next month, will you hold or will you panic and sell at the bottom, locking in the loss? If the honest answer is that you'd bail, then averaging in slowly might be the only way you stay invested at all. And staying invested beats every clever strategy you abandon. The best plan isn't the one that wins on a spreadsheet. It's the one you'll actually stick to through a bad month. So put the two together. If you can stomach the swings, lump sum wins on the math about 2 times in 3. Get the money working and let it compound. If a crash right after would make you sell, averaging in is insurance you pay for in a little expected return, and that can be worth every penny. But notice what loses either way: leaving it in cash, waiting for the right time. Both strategies beat the sidelines. The worst timing in the market still tends to beat sitting out of it. Illustrative, of course, not financial advice.